Welcome to our weekly earnings roundup. I'm Roy from Financial Intake, and today we're taking a closer look at the most significant earnings reports that shaped the market this week. This video summarizes the key takeaways, major stock movements, and the trends driving these results. Whether you're an investor, a market enthusiast, or just curious about what's happening in the business world, this summary has you covered. Stay with us until the end, and don't forget to like, subscribe, and hit that notification bell so you never miss our updates. Let's jump right in and see what made headlines this week. Today, we're diving deep into Palantir's Q3 2024 earnings report. This quarter has been solid for Palantir, showing impressive revenue growth, robust performance across AI-driven sectors, and strategic expansions in commercial and government markets. Let's break down the key numbers, explore the driving factors behind Palantir's growth, and look at what the company has planned as it continues to lead in the AI revolution. If you're interested in clear, in-depth financial insights, don't forget to like this video, subscribe to Financial Intake, and hit the notification bell so you won't miss any updates. Let's get started. Starting with revenue, Palantir achieved a remarkable 30% year-over-year growth, reaching $726 million. This growth is driven largely by the ongoing adoption of its AI capabilities. Focusing on the US, total U.S. revenue grew by 44% compared to last year, standing at $499 million, a testament to the company's strong presence in the American market. Delving deeper, U.S. commercial revenue surged 54% year-over-year to $179 million, marking a significant acceleration as businesses increasingly adopt Palantir's AI solutions. Meanwhile, U.S. government revenue grew by 40%, reaching $320 million. Indicating continued trust and reliance on Palantir's technology in the public sector. This balance between commercial and government growth demonstrates Palantir's versatility and ability to adapt to diverse sectors. Let's turn to profitability, where Palantir made notable progress this quarter. The company posted a GAAP net income of $144 million, representing a 20% margin. Year-over-year, Palantir's GAAP earnings per share doubled to 0 pesos and 6. This improvement highlights the company's efforts to streamline operations and focus on high-margin contracts. Regarding operational efficiency, Palantir achieved an adjusted income from operations of $276 million, resulting in an impressive margin of 38%. Adjusted earnings per share grew 43% to 10 pesos, showcasing the company's effective cost management and enhanced profitability. These results reflect Palantir's commitment to maintaining robust financial performance while scaling up operations in response to AI demand. Now let's discuss Palantir's cash flow, a critical indicator of its financial resilience. The company generated $420 million in cash from operations with a strong margin of 58%. This robust cash flow performance is further supported by adjusted free cash flow, which reached $435 million this quarter, marking a 60% margin. Over the last 12 months, Palantir has generated over $1 billion in free cash flow, a clear indication of its strong financial health and the ability to reinvest in future growth initiatives. Palantir's cash reserves remain solid, ending the quarter with $4.6 billion in cash, cash equivalents, and U.S. Treasury securities. This substantial cash position, with no outstanding debt, gives Palantir a robust financial foundation to pursue strategic investments and potential acquisitions. Palantir's customer base continues to expand, with a 39% year-over-year increase in customer count. This quarter alone, the company closed 104 deals valued at over $1 million, underscoring Palantir's consistent appeal to both new and existing clients. Of these deals, 36 were valued at over $5 million, and 16 deals exceeded $10 million, reflecting Palantir's ability to secure high-value, long-term contracts. Furthermore, the company continues to expand its relationships within the commercial sector, which has seen nearly 5 times growth over the past 3 years. Palantir is focusing on expanding its U.S. commercial segment, which has shown notable results as companies across industries adopt AI to streamline operations, manage data more effectively, and make more informed decisions. A critical factor in Palantir's success this quarter is its focus on AI, particularly through the continued expansion of its artificial intelligence platform, AIP. Palantir's AI capabilities are proving to be transformative in sectors such as healthcare, manufacturing, and logistics. The company reported notable successes, including a partnership with a healthcare provider to reduce hospital stays by 15% and a collaboration with an industrial client that led to $30 million in savings. This quarter also saw Palantir sign a new 5-year contract with the U.S. military valued at up to $100 million. The contract aims to expand the Maven Smart System's AI and machine learning capabilities across military branches. This partnership underscores Palantir's commitment to supporting national security through cutting-edge AI technology. Looking forward, Palantir's outlook for Q4 is promising. The company projects revenue between $767 million and $771 million, with adjusted income from operations expected to range from $298 million to $302 million. For the full fiscal year, Palantir raised its guidance and now anticipates revenues between $2.805 billion and $2.809 billion. In the U.S. commercial sector alone, Palantir expects revenue to exceed $687 million, marking a growth rate of over 50%. Palantir also increased its adjusted free cash flow guidance to exceed $1 billion for the year, solidifying its commitment to long-term growth and profitability. This strong guidance, paired with Palantir's existing contracts and expansion plans, reflects the company's optimistic outlook as it continues to capitalize on the booming demand for AI solutions. In summary, Q3 2024 was a standout quarter for Palantir, showcasing robust growth in revenue, profitability, and customer engagement. The company's strategic focus on AI, paired with its extensive presence in both the commercial and government sectors, positions it as a leader in the evolving AI landscape. As Palantir continues to invest in AIP and strengthen its position, the future looks bright. If you found this analysis helpful and want to stay updated with the latest tech and financial insights, don't forget to like, subscribe, and hit the notification bell. Thanks for tuning in, and we'll see you next time. We're diving into ExxonMobil's Q3 2024 earnings report. This quarter was one of the strongest ExxonMobil has had in a decade, with impressive revenue growth, record production levels, ongoing investments in core energy operations, and future-focused low-carbon initiatives. In this video, I'll break down ExxonMobil's key financial metrics, highlight the most critical areas for investors, and look at what the future holds for one of the world's energy giants. Whether you're an investor or keen to stay informed on the energy sector, this video will give you a clear, insightful analysis of ExxonMobil's performance and strategy. If you find this video helpful, don't forget to like, subscribe to Financial Intake, and hit the notification bell to stay updated on all our latest breakdowns of major earnings reports. Let's get started. In Q3 2024, ExxonMobil reported strong earnings of $8.6 billion, translating to $1.92 per share on a diluted basis. While this is slightly down from Q2's earnings of $9.24 billion, the year-to-date earnings total $26.1 billion, showing stable and high performance. ExxonMobil generated $17.6 billion in cash flow from operations this quarter, reinforcing its financial strength and supporting shareholder returns and strategic investments. These results underscore ExxonMobil's ability to navigate volatile energy markets while maintaining strong profitability. Moving on to production, ExxonMobil achieved its highest liquids production in over 40 years, reaching 3.2 million barrels per day in Q3. Total production hit 4.6 million barrels of oil equivalent daily, a 5% increase from Q2. This growth was driven largely by the Permian Basin and Guyana, alongside new volumes from the Pioneer acquisition. ExxonMobil's focus on high-return assets and efficient operations positions it well to continue benefiting from robust production capabilities. ExxonMobil's Product Solutions division saw record high-value product sales, up 10% year-to-date. Although refining margins have been lower industry-wide, the segment achieved strong results through structural cost savings and expansion projects, including the Beaumont refinery. This strategic shift toward high-margin, value-added products aims to strengthen profitability and insulate the company from market volatility. Cash flow remains a core strength for ExxonMobil. The company reported a free cash flow of $11.3 billion this quarter. Year-to-date, ExxonMobil has returned $26.1 billion to shareholders, including $12.3 billion in dividends and $13.8 billion in share repurchases. ExxonMobil also announced a 4% increase in its quarterly dividend to $0.99 per share, marking its 42nd consecutive year of dividend growth. This dedication to returning value underscores ExxonMobil's commitment to delivering consistent long-term returns to its investors. ExxonMobil continues to lead in carbon capture and low-carbon projects. The company now has commitments to capture and store up to 6.7 million metric tons of CO2 per year, the largest announced volume in the industry. Additionally, the hydrogen production project in Baytown, Texas, is expected to become one of the world's largest low-carbon hydrogen facilities. These investments reflect ExxonMobil's dual approach of maximizing traditional energy production while building future-focused, sustainable energy solutions. What's next going to Q4? ExxonMobil anticipates full-year capital expenditures to stay within its guidance range of $28 billion, signaling a firm commitment to balanced growth and strategic investment. This capital is expected to fuel traditional high-return energy assets, such as increased production in key regions like the Permian Basin and Guyana, and an aggressive expansion into low-carbon projects, which are set to play a significant role in the company's future. These low-carbon investments include advancements in carbon capture and storage and hydrogen production, specifically with the Baytown Hydrogen Facility, which aims to become one of the world's largest low-carbon hydrogen production sites. ExxonMobil's proactive investment in these technologies highlights its dual strategy to maximize returns from oil and gas while positioning itself as a leader in sustainable energy solutions. Financially, ExxonMobil's strong balance sheet, with a debt-to-capital ratio of just 13%, provides significant flexibility and resilience, allowing the company to sustain and expand these investments, even amid market fluctuations. This solid foundation enables ExxonMobil to pursue new growth opportunities within the energy sector. It reinforces its ability to adapt to evolving market demands, securing immediate and long-term value for its investors. This expansion provides more detail on the types of investments and ExxonMobil's strategic balance between traditional and low-carbon projects, emphasizing the company's positioning for future growth. In summary, ExxonMobil's Q3 results reflect its balanced approach of leveraging core strengths while pioneering low-carbon initiatives. If you found this breakdown helpful, please like, subscribe, and turn on notifications to stay updated with our latest insights into significant earnings reports and financial strategies. Thanks for watching, and see you in the next video. Today, we're diving into a unique earnings report from Supermicrocomputer Inc., or SMCI. SMCI's Q3 report comes with a significant update from their independent special committee, an unusual step in quarterly filings. We'll explain this, as well as key financials and projections and how this may impact investors. Let's get into it. Before we get into the numbers, let's talk about the independent special committee, which SMCI's board of directors formed after certain concerns were raised by their auditing firm, EY. This committee conducted a 3-month investigation with independent counsel and found that the audit committee acted independently with no evidence of fraud or misconduct by management or the board. They also recommended several measures to strengthen SMCI's governance and internal oversight, which are expected to be implemented soon. This step signals SMCI's commitment to transparency and governance, a reassuring sign for investors, even if it's unconventional for a standard earnings release. Let's jump into the preliminary financials for Q3. SMCI reported net sales expected to fall between $5.9 billion and $6.0 billion, just below their initial guidance range of $6.0 to $7.0 billion. Their GAAP and non-GAAP gross margin is expected to be around 13.3%. Earnings per share also came in slightly above their initial guidance, with GAAP diluted EPS projected between $0.68 and $0.70, and non-GAAP EPS ranging from $0.75 to $0.76. While slightly below sales expectations, this performance still shows steady earnings strength. Looking ahead to Q4, SMCI projects net sales in the range of $5.5 billion to $6.1 billion. GAAP earnings estimate diluted EPS to be between $0.48 and $0.58, while non-GAAP diluted EPS is expected to be slightly higher at $0.56 to $0.65. These projections consider tax rates and stock-based compensation expenses, a notable factor in SMCI's non-GAAP adjustments. The company is financially stable, with approximately $2.1 billion in cash reserves and a total debt of around $2.3 billion, ensuring it has the resources needed for ongoing growth and stability. An important update for SMCI investors: the company is currently working to regain compliance with NASDAQ listing requirements. This situation arose due to a delay in filing their Form 10-K for fiscal 2024, which is due in August. In September, SMCI received a notice from NASDAQ providing a 60-day window to submit a compliance plan. If the plan is approved, SMCI may receive an extension of up to 180 days to regain compliance, allowing it to maintain its NASDAQ listing status. SMCI has committed to meeting these requirements as soon as possible. SMCI's forward-looking strategy remains solid, despite these compliance challenges. They continue to focus on growth in key sectors like AI, cloud infrastructure, and 5G. The recent measures recommended by the Special Committee will further strengthen their internal controls and transparency, which could enhance investor confidence. The company has also reiterated its dedication to responsible financial practices, adapting its strategy based on the independent committee's findings. In summary, while SMCI's Q3 report came with some unusual updates, the overall financial performance remains steady, and the company is taking clear steps to address governance and compliance issues. If you're following SMCI or are invested in tech solutions and IT infrastructure, this update is one to watch. If you found this breakdown helpful, like, subscribe, and hit the notification bell to stay updated with our latest insights into financial reports and key industry developments. Thanks for watching and see you next time. Today, we're diving into Lumen Technologies' Q3 2024 earnings report. This quarter, Lumen demonstrated significant progress in its transformative journey, aiming to redefine itself in the AI-driven economy. The company has been expanding its fiber footprint, developing advanced network infrastructure, and strategically positioning itself in AI connectivity. In this video, we'll explore Lumen's financial performance, its AI and connectivity solution strides, and what this all means for investors. Let's get started. To begin, here is a quick note on Lumen's use of forward-looking statements and non-GAAP measures. The company uses these tools to offer clearer insights into its growth strategy, financial expectations, and operational goals. However, investors need to remember that these projections are based on assumptions about future market trends, economic conditions, and internal decision-making, all of which carry inherent risks. Lumen encourages investors to review these metrics with a clear understanding of the potential uncertainties involved. You can refer to the full disclaimer in the earnings report. This quarter, Lumen has achieved significant milestones in its operational transformation, as the company seeks to redefine telecom by moving towards a more agile, digital-first model. Their quantum fiber business recorded a record high in new subscriptions, a clear indicator of growing demand for high-speed fiber broadband. This segment remains pivotal to Lumen's strategy, mainly as they invest heavily in fiber expansion to enhance service quality and improve speed capabilities across various regions. Additionally, Lumen is aggressively pursuing the growth of its network as a service NAS offerings. NAS is a cloud-based model that allows businesses to scale their networking solutions more flexibly and efficiently, a significant advantage in the digital economy. The adoption of NAS positions Lumen at the intersection of cloud and connectivity, helping to capture market share in high-growth areas like AI, IoT, and edge computing. This focus on high-tech, adaptable solutions is central to Lumen's transformation strategy, aiming to cater to modern enterprises' evolving connectivity needs. Lumen has introduced its private connectivity fabric, an advanced network architecture explicitly built to support the demands of AI applications. With data traffic surging due to AI-driven workloads, Lumen's fabric is engineered for high throughput, low latency, and robust security, making it an ideal solution for enterprises that rely on AI for real-time decision-making. This connectivity fabric integrates with Lumen's existing fiber infrastructure, amplifying its ability to handle large volumes of data efficiently and securely. The significance of this architecture lies in its potential to attract partnerships with big tech and AI companies, which require top-tier infrastructure to power their machine learning, deep learning, and other AI operations. By focusing on the requirements of these cutting-edge fields, Lumen is positioning itself not only as a telecom provider, but as a vital enabler of the AI economy. As the company continues to roll out this infrastructure, we can expect more announcements and collaborations shortly, which could open up additional revenue streams and strengthen its market position. Lumen's total revenue for Q3 2024 was reported at $321 billion, marking an 11.5% decrease from the previous year. This decline reflects broader trends impacting the telecom sector, such as market competition, economic factors, and the impact of Lumen's recent divestitures. It's also worth noting that while revenues have declined, Lumen's core U.S. enterprise business has shown resilience. This area remains vital to Lumen as it serves large enterprises and public sector customers who depend on stable, reliable connectivity solutions. Despite the revenue drop, Lumen strategically focuses on enhancing high-growth segments, particularly fiber broadband and AI-driven connectivity. This approach could stabilize revenue and drive recovery in the coming quarters as these new initiatives gain traction. Within the mass market segment, Lumen's fiber broadband revenue grew impressively by 16.6% year over year, reaching $190 million. The increase reflects strong demand for faster internet speeds and reliable connectivity, especially as more households and small businesses upgrade to fiber-based services. Lumen added 43,000 new fiber subscribers this quarter, showing that their investment in expanding fiber networks is attracting a growing customer base. This fiber expansion is also part of Lumen's long-term vision, establishing a market-leading position in high-speed internet. Fiber broadband provides significant competitive advantages over traditional broadband, including faster speeds, excellent reliability, and scalability for future technologies. As Lumen continues to roll out fiber in underserved areas and urban centers alike, it expects this segment to become a central pillar of revenue growth. Lumen's adjusted EBITDA for Q3 2024 came in at $899 million, a 14.3% decrease from the prior year. While adjusted EBITDA declined, it's essential to consider this metric in light of Lumen's structural changes and divestitures. The EBITDA margin was relatively substantial at 27.9%, only slightly down from 28.8% in Q3 2023, indicating that Lumen has managed to maintain operational efficiency despite revenue pressures. The steady margin suggests Lumen is making progress in streamlining its cost structure. This focus on efficiency allows the company to direct more resources toward growth initiatives, particularly in AI connectivity and fiber broadband, which are expected to be key drivers of future profitability. Investors will be watching closely to see if Lumen can continue to balance cost management with expansion in high-potential segments. Lumen reported $1.2 billion in free cash flow for Q3, showcasing strong cash generation and reinforcing its financial flexibility. Free cash flow is critical as it allows Lumen to fund capital-intensive initiatives such as expanding fiber networks and investing in AI-driven solutions without over-reliance on external financing. This quarter's cash flow performance is a positive indicator, showing that Lumen's core operations remain robust and can generate substantial cash. This liquidity is also crucial for managing debt, a priority for Lumen as it strives to maintain a healthy balance sheet. With a strong cash position, Lumen is well-positioned to service its debt while continuing to invest in growth initiatives, which is essential for long-term sustainability and shareholder value. Looking ahead, Lumen reaffirmed its guidance for 2024, with expectations for adjusted EBITDA between $3.9 and $4.0 billion, and free cash flow in the range of $1.2 to $1.4 billion. This guidance reflects the company's confidence in its transformative strategy, focusing on high-growth areas like fiber broadband and AI-enabled connectivity solutions. The commitment to this outlook underscores Lumen's strategic priorities: driving growth in fiber broadband, enhancing digital infrastructure, and capitalizing on its new AI-focused architecture. As Lumen continues implementing the recommendations from its transformation strategy, the company aims to strengthen its competitive position in the rapidly evolving tech landscape, potentially leading to revenue stability and growth in the coming years. In conclusion, Lumen's Q3 2024 earnings report shows a company amid a significant transition, with encouraging growth in fiber broadband, substantial cash flow generation, and promising initiatives in AI connectivity. The continued focus on transformative infrastructure and strategic investments could position Lumen for growth in the tech-driven future. If you enjoyed this deep dive and want to stay updated on more earnings insights, like, subscribe, and hit the notification bell. Thanks for tuning in to Financial Intake, and we'll see you next time. Q3 2024, Novo Nordisk's financial performance stood out with a 24% sales growth at constant exchange rates, reaching DKK 204.7 billion. This growth is mainly driven by the GLP-1 portfolio, which grew by 26% due to the strong performance of Ozempic registered trademark and Wegovy registered trademark. Gross margin also improved slightly, maintaining high profitability with an operating margin of 44.7%. The company expects a continued rise in its operating profit for the entire year, emphasizing robust financial stability. Novo Nordisk continues to lead in the diabetes and obesity markets with a global market share now at 33.9%. The company has tripled its GLP-1 patient reach over the past 3 years, covering approximately 11.5 million patients and capturing a 65% global volume market share in the GLP-1 category. This substantial market presence in diabetes and obesity treatments positions Novo Nordisk as a dominant force in managing two of the most critical health conditions worldwide. Scaling its GLP-1 portfolio, Novo Nordisk has invested over 125 billion DKK since 2021, including recent announcements to expand production capacity. These investments are set to enhance product availability and optimize the portfolio to meet rising global demand. As the leader in GLP-1 therapies, Novo Nordisk's strategic scaling efforts are designed to ensure consistent supply while accommodating future growth in diabetes and obesity care. In Q3, Novo Nordisk also reported promising developments in its rare disease pipeline, with a 21% growth in rare endocrine disorder sales driven by new product launches like Sogroya registered trademark and an increased manufacturing output. The company is set to expand its reach in treating complex conditions such as hemophilia and growth disorders. Although more minor in revenue, this area remains crucial to Novo Nordisk's diversified healthcare strategy. Novo Nordisk's commitment to innovation is evident in its active pipeline across multiple therapeutic areas, including diabetes, obesity, cardiovascular, and rare diseases. Notable milestones include the successful completion of the SOUL cardiovascular trial and positive data in obesity-related clinical trials. Novo Nordisk plans further regulatory submissions for breakthrough therapies like oral semaglutide in diabetes and semaglutide for MASH in obesity, which could redefine treatment standards in these areas. Looking ahead, Novo Nordisk is optimistic about 2024, with projected sales growth of 19 to 21% and free cash flow expected to reach DKK 57.65 billion. The company's consistent growth and robust cash flow enable it to return significant value to shareholders while also funding future R&D. With a debt-to-capital ratio of around 13%, Novo Nordisk remains financially strong, supporting its long-term goals in innovation and market expansion. Novo Nordisk is committed to sustainability, with initiatives to minimize its environmental impact and foster corporate responsibility. The company has made strides toward its zero-impact goal, despite a 34% increase in CO2 emissions this year, largely due to scaling efforts. Additionally, Novo Nordisk has supported over 59,000 children through its Changing Diabetes registered trademark in children program, showcasing its dedication to community health globally. In summary, Novo Nordisk's Q3 results reflect strong financial performance, strategic growth in diabetes and obesity care, and an unwavering commitment to innovation and sustainability. For investors, Novo Nordisk's diversified pipeline, expansive market presence, and sustainable growth trajectory make it a compelling choice in the healthcare sector. Thanks for tuning in to Financial Intake. Be sure to like, subscribe, and hit the notification bell for more insights on the latest market updates. That wraps up our breakdown of Novo Nordisk's Q3 2024 earnings. Novo Nordisk is making impressive strides in financial performance and addressing significant health challenges worldwide, from diabetes and obesity to rare diseases. Their commitment to innovation and sustainability positions them well for future growth. If you found this analysis helpful and want to stay updated with insights on top-performing companies, be sure to like, subscribe, and hit that notification bell. And hey, if you're interested in more cutting-edge updates from the tech side of things, check out our recent breakdown of Palantir's Q3 report. It's packed with insights on AI-driven growth and strategic moves in the tech space. Worth a watch. Thanks for tuning in to Financial Intake, and we'll see you in the next video. We're breaking down ARM Holdings' Q2 FYE 25 earnings report. This quarter is significant for ARM as it navigates its post-IPO trajectory, demonstrating strong results and strategic expansion. The company's focus on leading-edge chip architecture and strategic entry into high-demand sectors like AI and automotive highlights its proactive approach to growth. If you enjoy staying informed with concise financial insights, be sure to like this video, subscribe to Financial Intake, and hit the notification bell so you never miss an update. ARM's performance underscores its critical role in the semiconductor industry and positions it as a key enabler of future technology. ARM reported strong financials for Q2, achieving revenue of $746 million, representing steady year-over-year growth despite global economic challenges. This performance is powered by the company's consistent licensing deals and increasing royalty streams. ARM's ability to maintain a robust revenue base showcases its resilience and market leadership, particularly as it continues to capitalize on the surging need for efficient and powerful chip designs across various industries. With demand expected to continue rising, ARM's revenue performance positions it well for sustained growth. Licensing and royalty revenues were standout performers in Q2. Royalty revenue increased by 10% year-over-year, reaching $430 million, driven by the widespread implementation of ARM-based solutions in consumer electronics, automotive, and IoT devices. Licensing revenue contributed an additional $316 million, boosted by strategic agreements with key industry players. This dual growth in both revenue streams underscores Arm's effective strategy of balancing near-term cash inflow through licensing with long-term stable revenue from royalties. Such a balanced approach is pivotal for maintaining a solid financial foundation while enabling further innovation and expansion. The ARM v9 architecture continues to be a significant driver of Arm's royalty growth. This cutting-edge technology, known for its enhanced security features, performance improvements, and AI capabilities, has been embraced by major sectors including smartphone manufacturers, data centers, and cloud providers. The architecture's success exemplifies Arm's commitment to addressing the complex demands of modern computing environments. The broad adoption highlights Arm's capacity to innovate and deliver solutions that resonate with the needs of high-performance, secure computing. This strong uptake in ARM v9 positions the company as a leader in advanced architecture solutions. ARM has made significant strides in developing compute subsystems tailored for AI integration. These subsystems are designed to meet the demands of AI workloads, enabling partners to reduce their time to market and enhance computational efficiency. By positioning itself at the heart of AI-driven innovation, ARM has strengthened partnerships with major tech players like Meta, showcasing its pivotal role in supporting AI advancements. This focus allows ARM to address emerging trends in machine learning and deep learning, positioning the company not only as a semiconductor provider, but as a leader in cutting-edge AI infrastructure. This move reinforces ARM's dedication to aligning its technology with the future of global computing needs. Financial performance for ARM in Q2 included an operating income of $138 million, supported by strong revenue and efficient cost management. The net income for the quarter reached $105 million, with non-GAAP adjusted net income at $176 million. Despite tax impacts and external economic variables that could challenge profitability, ARM has maintained a healthy bottom line. The focus on high-margin royalty revenues and strategic licensing partnerships continues to bolster these results. This resilience in income performance signals to investors that ARM is capable of maintaining profitability even amid industry fluctuations. ARM's future outlook remains strong, with projections indicating continued growth into Q3 and beyond. The company is leveraging its core strengths to expand into lucrative markets like AI, automotive, and the IoT sector. This strategic shift reflects ARM's dedication to diversifying its revenue sources and sustaining its leadership in semiconductor solutions. Investments in R&D are slated to continue at a robust pace, ensuring that ARM remains competitive and adaptive to the rapidly evolving demands of global technology markets. For investors, this forward-looking approach signals a promising trajectory supported by a strong foundation and clear strategic vision. Thanks for tuning into this breakdown of ARM Holdings Q2 FYE25 earnings report. If you found this analysis helpful, don't forget to like, subscribe, and hit that notification bell for more in-depth financial insights. And if you're interested in more updates from the tech and innovation space, I highly recommend checking out our recent video on Palantir's Q3 earnings. It's packed with insights on their strategic moves and how they're positioning themselves in the AI landscape. See you next time on Financial Intake. Today we're diving into Qualcomm's Q4 FY 2024 earnings report. Qualcomm continues to cement its role as a global leader in wireless technology and semiconductor innovation. This quarter, the company reported a significant revenue of $10.2 billion, supported by robust performance in their QCT and QTL segments. Qualcomm's strategic focus on 5G advancements, automotive technology, and IoT has driven growth and reinforced its competitive position. Let's jump right in if you're ready to get a concise breakdown of Qualcomm's financial highlights and strategic wins this quarter. In Q4 FY 2024, Qualcomm reported revenues of $10.2 billion, exceeding the high end of their guidance range. This marks a percent year-over-year increase, underpinned by strong QCT revenues of $8.7 billion and QTL revenues of $1.5 billion. The company's strategic investments in expanding its 5G handset offerings and leveraging new markets like automotive and IoT contributed to this solid revenue performance. This growth is an indicator of Qualcomm's adaptability and strategic positioning amid shifting market dynamics. The QCT Qualcomm CDMA Technologies segment was a major driver this quarter, generating $8.7 billion in revenue and reflecting both handsets and automotive growth. Notably, automotive revenues soared by 68% year-over-year, reaching $899 million, demonstrating Qualcomm's expanding footprint in the smart vehicle ecosystem. IoT revenues also showed strength at $1.7 billion, underscoring the company's success in diversifying its business model. The Snapdragon Elite platforms continued solidifying Qualcomm's position in high-performance markets, enhancing revenue and market relevance. Qualcomm's QTL, Qualcomm Technology Licensing segment, maintained its solid performance, contributing $1.5 billion in revenue with an EBT margin of 74% at the high end of guidance. The sustained success of the QTL segment highlights the importance of Qualcomm's extensive patent portfolio, which secures consistent royalty streams and supports strategic partnerships. This revenue stream is crucial for funding ongoing innovation and ensuring the company's leadership in cutting-edge technology. Throughout FY 2024, Qualcomm has focused on strategic investments that will pave the way for long-term growth. The company has committed substantial resources to advancing AI capabilities and enhancing its automotive technology through the Snapdragon Ride and Snapdragon Cockpit platforms. These investments are designed to position Qualcomm at the forefront of the evolving landscape in AI-driven applications and the automotive tech space, aligning with market trends towards smarter connected devices. Despite strong results, Qualcomm faces challenges such as fluctuating global demand and supply chain constraints. The competition in the semiconductor space remains intense, and economic uncertainties could affect consumer demand. However, Qualcomm's strategic expansion into automotive and IoT sectors, coupled with continued investment in R&D, positions it to weather these challenges effectively. The company's Q1 FY 2025 guidance projects revenues between $10.50 and $11.3 billion, indicating cautious optimism moving forward. Looking ahead, Qualcomm's future strategies focus on scaling their AI and 5G offerings while boosting their automotive and IoT segments. For FY 2025, the company anticipates further revenue growth, with expectations of higher operating margins and strong cash flow generation. Investors should watch for Qualcomm's next steps in cementing partnerships and expanding their technology portfolio to maintain a competitive edge. With a robust financial position and clear strategic goals, Qualcomm is poised for sustained growth in a rapidly evolving tech landscape. Thanks for tuning into our breakdown of Qualcomm's Q4 FY 2024 earnings report. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more in-depth financial updates. And if you're keen on more semiconductor insights, check out our recent video on ARM Holdings Q2 FYE25 earnings report. It offers valuable perspectives on their post-IPO growth and strategic moves in the semiconductor market. See you next time on Financial Intake. Stay informed and keep investing wisely. Today, we're breaking down Mercado Libre's Q3 2024 earnings report. Mercado Libre continues to showcase its strong leadership in Latin American e-commerce and fintech. This quarter, we marked a solid growth in gross merchandise volume, GMV, and an impressive increase in fintech activity. The company achieved net revenue of $5.3 billion, up 35% year-over-year, driven by robust marketplace and fintech services expansion. Mercado Libre's focus on integrating e-commerce with comprehensive financial solutions has propelled them forward despite macroeconomic challenges. Let's explore these achievements and what they mean for current and future growth. This quarter, Mercado Libre reported a significant growth in marketplace activities. GMV reached $12.9 billion, marking a 35% year-over-year increase. Items sold rose by 28%, indicating increased consumer engagement across its platforms. Unique active buyers also grew by 21% to nearly 61 million, the highest growth rate since the pandemic. Brazil and Mexico showed stable high growth, while Argentina experienced a resurgence in consumer activity due to improving economic conditions. These figures highlight Mercado Libre's resilience and its strategic ability to attract and retain users in a competitive market. Mercado Pago, Mercado Libre's fintech arm, experienced accelerated growth, contributing significantly to the company's overall performance. Fintech monthly active users, MAUs, rose 35% year-over-year to 56 million. The credit portfolio expanded to $6 billion, representing a 77% year-over-year increase, with credit card growth outpacing other categories at 172%. This robust expansion emphasizes Mercado Libre's strong position as a financial enabler in Latin America, showcasing its adaptability and the increasing integration of digital payment solutions across the region. In Q3 2024, Mercado Libre delivered robust financial results highlighting its strong market position and effective growth strategy. The company reported total net revenues of $5.3 billion, marking an impressive 35% increase compared to Q3 2023. This growth was driven by substantial contributions from its e-commerce marketplace and fintech services, showcasing its ability to generate diverse revenue streams. In Q3 2024, Mercado Libre delivered robust financial results highlighting its strong market position and effective growth strategy. The company reported total net revenues of $5.3 billion, marking an impressive 35% increase compared to Q3 2023. This growth was driven by substantial contributions from its e-commerce marketplace and fintech services, showcasing its ability to generate diverse revenue streams. The revenue breakdown shows that marketplace services remain dominant, contributing significantly to the total. The increased GMV of $12.9 billion underscores strong consumer activity across its platforms, with items sold up by 28% year over year. This growth was supported by higher engagement from unique active buyers, which climbed by 21% to nearly 61 million. This user base expansion highlights Mercado Libre's success in maintaining a competitive edge and attracting customers despite economic headwinds in various Latin American markets. Fintech revenue also saw notable growth, driven by increased adoption of digital wallets, payment solutions, and credit services. This segment now represents a larger share of the company's revenue, showcasing the dual strength of Mercado Pago alongside the traditional marketplace. This integration of commerce and financial services supports revenue diversification and strengthens user retention and engagement across the platform. These financial metrics underline Mercado Libre's resilience, strategic investments, and the growing importance of its comprehensive ecosystem that bridges e-commerce and fintech. The balanced growth across segments positions the company well to continue its trajectory in an increasingly competitive digital marketplace. Mercado Libre's gross profit margin for Q3 2024 was 45.9%. Showing some margin compression compared to last year. A higher mix of first-party sales and increased logistics and customer acquisition investment influenced this decline. Despite this, the strategic investment in logistics, including same and next-day delivery capabilities, has reinforced customer loyalty and long-term profitability. The company remains committed to balancing growth with sustainable margin management to maintain competitiveness and service quality. The acquiring business saw strong growth, with total payment volume, TPV, reaching $36 billion, up 21% year over year. In Brazil, FX-neutral TPV grew by 30%, while Mexico outperformed with a 46% increase. Expanding on-platform and off-platform payment services continues to strengthen Mercado Libre's ecosystem. Cross-selling additional services to merchants, particularly in-store credit offerings, has bolstered TPV growth and showcases the company's strategic focus on deepening merchant relationships and expanding its financial service footprint. Looking ahead, Mercado Libre's growth strategy is set to focus on strengthening its competitive advantage through technology and continued investment in infrastructure. The company plans to enhance its logistics capabilities to ensure even faster and more reliable delivery services, which has become a cornerstone of its customer satisfaction strategy. By expanding its fulfillment network, Mercado Libre aims to increase the share of same-day and next-day deliveries, reinforcing its leadership in the e-commerce sector and boosting customer loyalty. Fintech remains a core growth area, with Mercado Pago leading the charge. The company plans to scale its credit portfolio thoughtfully, emphasizing quality over sheer volume to maintain strong asset performance. This approach is crucial in managing potential credit risks while maximizing the reach and impact of its financial services. Cross-selling strategies, such as offering merchants more integrated payment and credit options, will continue to enhance revenue streams and deepen relationships within its ecosystem. Mercado Libre also aims to increase its focus on digital innovations to streamline operations and introduce new services that enhance user experience. This includes leveraging data analytics and AI to optimize product recommendations, boost operational efficiency, and personalize customer interactions. On the merchant side, the company is expanding its offerings to support small and medium-sized enterprises, SMEs, ensuring they have access to the tools and resources needed to thrive on the platform. Investors should take note of Mercado Libre's strategic initiatives designed to capture the ongoing digital transformation in Latin America. By bolstering its core capabilities in both commerce and fintech, Mercado Libre is positioning itself for continued growth in an increasingly competitive landscape. These moves reinforce its goal of sustaining profitability while driving long-term user engagement and market expansion. Thanks for watching this breakdown of Mercado Libre's Q3 2024 earnings report. If you found this analysis helpful, like, subscribe, and hit that notification bell for more financial insights and company updates. And if you're interested in more in-depth tech and financial reviews, don't miss our recent video on Palantir's Q3 earnings. It's packed with insights into how they're leading the AI revolution and expanding their market presence. Check it out for a broader perspective on innovative companies shaping the future. See you in the next video on financial intake. Stay informed and keep investing wisely. Hi, I'm Roy from Financial Intake. Today we'll analyze Vistra Corp's Q3 2024 earnings results, revealing how the company has performed this quarter and its strategic moves to solidify its position in the energy sector. Vistra's proactive capital allocation, solid operational metrics, and guidance updates are key to understanding its trajectory and future potential. Let's dive into these figures and discuss what they mean for investors. Vistra showcased strong financial performance in Q3 2024, reporting adjusted EBITDA of $1.44 billion. This robust figure highlights Vistra's ability to maintain operational efficiency, despite external challenges such as the milder weather conditions in Texas that historically impact energy demand. The company's proactive strategies in energy hedging and diversified energy production contributed to this better-than-expected performance. Revenues for the quarter were driven by consistent contributions from both the traditional fossil fuel and growing renewable energy segments, underscoring Vistra's balanced approach to energy generation. The increase in earnings has led the company to adjust its full-year guidance upward, now projected at €5 to $5.2 billion. This revision reflects confidence in sustained operational strength and highlights the strategic decisions made in resource management and expansion into clean energy. The positive financial results reassure stakeholders of Vistra's resilience and set a solid foundation for growth heading into 2025. Vistra continues to prioritize shareholder returns with its robust capital allocation strategy. In Q3 2024, approximately $3.5 billion was allocated for share repurchases, including $3.1 billion towards increasing ownership in Vistra Vision. Additionally, $400 million went towards open market share repurchases. This underscores Vistra's commitment to maintaining a balanced approach to growth and shareholder value. Operational excellence remains at the heart of Vistra's strategy. The company maintained a commercial availability of 96% for fossil fuel generation and a capacity factor of 98% for its nuclear assets. Vistra is also heavily invested in transitioning to cleaner energy sources, aligning with its strategic focus on sustainable growth and energy transition. This aligns with their mission to drive reliability and cost efficiency. Vistra's long-term earnings outlook is promising, with ongoing operations adjusted EBITDA guidance for 2025 set at $5.5 to $6.1 billion. The guidance reflects continued confidence in their comprehensive hedging program and strategic energy investments. Additionally, future EBITDA projections for 2026 indicate a potential midpoint of over $6 billion, showcasing Vistra's growth opportunities in the years ahead. Financial stability is a priority for Vistra, as evidenced by its net leverage ratio of 2.7x. With available liquidity of approximately $4 billion, the company is well equipped to support operational needs and future growth initiatives. Vistra's focus on debt management ensures a sustainable financial structure that can weather market fluctuations. Vistra continues to make strides in its sustainability efforts, with plans to retire over 20,000 megawatt-hours of fossil fuel generation by 2027. The company also highlighted its zero-carbon generation growth, showcasing a significant increase of over 200% since 2018. These initiatives align with Vistra's long-term goal of achieving net zero carbon emissions by 2050, reinforcing its commitment to environmental stewardship. Vistra's future-oriented strategy is marked by significant investments across both traditional energy sources and renewable technologies. One of the main highlights is their continued expansion in solar power projects, which are expected to substantially increase the company's zero-carbon electricity output over the next few years. Energy storage remains another critical area, with Vistra developing large-scale battery projects designed to enhance grid reliability and support intermittent renewable energy. These strategic investments are not only poised to boost Vistra's revenue in the coming years, but also align with global trends emphasizing cleaner and more sustainable energy production. The integration of renewable assets, smart grid technology, and energy management systems ensures that Vistra remains competitive in an industry rapidly shifting towards sustainability. Furthermore, ongoing investments in technology-driven enhancements, such as digital monitoring and predictive maintenance for their energy assets, illustrate Vistra's commitment to maintaining operational excellence while positioning for future growth. The company's forward-thinking approach to energy generation and management sets a strong precedent for continued leadership in both traditional and renewable markets, reflecting a commitment to innovation, sustainability, and long-term profitability. Vistra's Q3 2024 results reflect a company that is not only navigating the present challenges effectively, but is also laying down the foundations for future success. Their strategic capital allocation, focus on operational efficiency, and commitment to sustainability underscore a promising outlook. Investors should keep a close watch on how Vistra leverages its strong position to drive long-term growth. Thanks for watching this breakdown of Vistra Corp's Q3 2024 earnings. If you found this analysis insightful, I recommend checking out our recent video on ARM Holdings' latest report for more in-depth financial insights. Don't forget to like, subscribe, and stay tuned for more updates on the biggest names in the industry. See you next time. Today we're breaking down Affirm's Q1 fiscal year 2025 earnings report. Affirm, known for its buy now, pay later (BNPL) services, has been navigating a competitive and evolving financial landscape. This video will discuss key financial highlights, revenue trends, and future outlooks to help you understand where Affirm stands and what investors should watch. If you enjoy videos that keep you informed and empower your investment strategy, be sure to like, subscribe, and hit that notification bell so you don't miss any updates. Stick with us for this insightful breakdown. Affirm reported strong revenue growth for Q1 FYE25, reaching $445 million, representing a notable year-over-year increase. This growth is attributed to higher consumer demand for BNPL services and strategic partnerships that boosted transaction volumes. The company's gross merchandise volume, GMV, climbed, indicating continued user engagement and expanding market share. While revenue numbers were strong, it's essential to consider the competitive landscape and how it impacts Affirm's future growth trajectory. In terms of profitability, Affirm reported a net loss of $206 million for Q1 FYE25, reflecting ongoing investments in technology and market expansion. Although a loss can raise concerns, the company emphasized its commitment to enhancing platform capabilities and expanding into new markets. Affirm's leadership believes these investments will set the stage for long-term profitability. Investors should consider these numbers alongside potential revenue growth and market positioning. A major highlight from Q1 is Affirm's expansion of partnerships with major retailers and e-commerce platforms, which has fueled its growth. Collaborations with prominent companies have helped strengthen its presence in the competitive BNPL market. These partnerships increase user adoption and diversify Affirm's revenue streams, a crucial step as the company aims to solidify its market share. Affirm's outlook for the remainder of fiscal year 2025 remains cautiously optimistic, reflecting growth opportunities and challenges. The company has projected continued revenue growth driven by increased consumer adoption of buy now, pay later (BNPL) services and expansion into new markets. Affirm's leadership is strategically emphasizing partnerships with major retailers and digital platforms to embed its services across various e-commerce ecosystems further, which could bolster transaction volume and gross merchandise value (GMV). However, the company acknowledges that macroeconomic headwinds, such as potential shifts in consumer spending patterns and broader economic uncertainty, could impact growth. Inflation and rising interest rates may affect loan performance, influence consumer repayment behavior, and impact Affirm's bottom line. Affirm is also investing heavily in technological advancements to enhance its platform's user experience and operational efficiency. This includes leveraging data analytics and artificial intelligence to improve risk assessment and customer engagement, positioning Affirm to capture a larger market share. Additionally, the company is exploring international markets, seeking opportunities to scale its operations beyond the US, which could diversify its revenue streams. Management remains focused on balancing growth with profitability, emphasizing that while short-term losses may persist, these strategic investments are designed to secure long-term gains. Investors should watch Affirm's ability to adapt to economic conditions and navigate regulatory developments, which will be crucial to its sustained success. Despite positive revenue growth, Affirm faces challenges such as increased competition from traditional financial institutions and other BNPL providers. Regulatory changes and evolving consumer credit behavior also pose risks that could impact future profitability. Investors should know these factors when assessing the company's long-term potential. Affirm's Q1 FYE25 earnings reflect a company balancing growth with strategic investments while navigating a dynamic market. With strong revenue growth and expanding partnerships, Affirm shows promise. However, profitability remains challenging, and external factors could affect its trajectory. It's essential to watch how Affirm adapts to competition and regulatory shifts. Thanks for watching this breakdown of Affirm's Q1 earnings report. If you found this analysis helpful, don't forget to like, subscribe, and hit that notification bell for more financial insights. And if you're interested in broader market impacts, check out our video on top stocks to buy and avoid under Trump's presidency to see how political changes could shape your investment strategy. See you next time on Financial Intake. Stay informed and invest wisely.